The covered call ETF SPYI is quickly gaining in popularity due to a multitude of reasons, with a starting yield of above 12%, monthly payouts, a unique tax-efficient structure, and the potential for share price appreciation. SPYI is proving it may just be one of the best covered call ETF options out there. I've been actively putting together a spreadsheet with in-depth data on more than 60 plus covered call ETFs, and the more I look at each of these covered call ETFs, how they operate, the different strategies, whether they're active or passive, the different option moneyness, and the portfolio options coverage, the more I'm convinced SPYI is one of the best covered call ETFs for most investors. Now, this is due to a few different reasons, but before we dive into the reasons that make SPYI a little bit better than a lot of other covered call options out there, we need to understand the very basics of the fund. To start off, we can see SPYI is the NEOS S&P 500 High Income ETF. On the fund's website, we can see the benefits of SPYI strategy. 1. The fund seeks to distribute high monthly income generated from investing in the S&P 500 index and implementing a data-driven call option strategy. Number 2, this is an actively managed fund by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates, and we'll touch on this more later in the video. The fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. So what are the 3 key points here? Number 1, yes, the main goal is to generate high monthly dividends. Number 2, their goal is to do it in a tax-efficient manner. And number 3, they want to take part in capturing some of the upside in bull markets. And this one's interesting because this is what a lot of covered call ETFs fail to do. For example, despite the recent market sell-off, we can see since the beginning of 2023, SPYI has outperformed the other very popular covered call ETF JEPI by a pretty decent amount. And keep in mind, the majority of this outperformance came during the midst of a huge bull run in 2023 and 2024. Now, it's really important we understand what allows SPYI to climb higher during bull markets than a lot of other covered call ETFs. And this is where we have to understand options moneyness and portfolio options coverage. Let's take a closer look at SPYI. If we scroll over and look at these 2 key metrics, here's what we can see. SPYI options moneyness is out of the money calls. Why is this significant? Well, we have to understand there are 3 main different types of call options. We have at the money calls, in the money calls, and out of the money calls. At the money calls typically have high premiums, but caps almost all of the upside, so this is typically good in sideways or slightly bearish markets. Then we have in the money calls. These have the highest premiums, meaning they probably typically pay out the largest distribution, but they sacrifice upside completely. So this is typically best in bear markets. But then we have out of the money calls. These will typically have lower premiums, but it allows some market upside. So typically slightly lower distributions, but they can take part in the market upside. So SPYI is designed to do best in bull markets. And as we dig into the holdings of the fund, we'll see this remains true. Let me show you what I mean. If we jump over to the prospectus for SPYI, which anytime you're interested in a new ETF, you have to look at the prospectus to make sure you understand the fund. But here's what it tells us. The fund will generally use a replication strategy to invest in the S&P 500, meaning the fund will generally invest in all the component securities of the S&P 500 in the same approximate proportions as in the S&P 500. So what does this mean? Well, if we look at the top holdings on the fund's website, we can see the top holdings: Apple, Microsoft, Nvidia, Amazon, Meta, Berkshire Hathaway, Google, Broadcom, and then Tesla. These are the exact same top holdings as the S&P 500. If we look at the S&P 500 holdings, again, you're going to notice it's nearly exactly identical. Now, this is important because what do we know about the S&P 500 over the long term? While there might be volatility in the short term, as we know, in the long term, the S&P 500 does very well. It goes up over the long term. And because SPYI writes out of the money calls, it's designed to do better in bullish markets. So it makes a lot of sense why the underlying holdings of SPYI would be the same as the S&P 500. Now, keep in mind the fund is certainly not designed to outperform the S&P 500 over the long term, but what we can see year to date with the huge sell-off in the market over the last few months is that SPYI from a total return perspective actually has outperformed the S&P 500. Along with this, we can see that net asset value, which is the true indicator of value, for this fund has been growing since inception. So again, this fund has been able to take part of the market upside over the last few years. And being able to take part of that market upside is something a lot of covered call ETFs do not offer. This is certainly something that I like about SPYI. But the benefits of the fund don't just stop there. If we jump over to the dividend tab for this fund and look at the dividend history, what do you notice? If we look at the historic dividend payouts for this fund since inception, you'll notice it's relatively stable, which is very rare for a covered call ETF. For example, if we come over here and look at JEPI, the JP Morgan Equity Premium Income ETF, and look at the dividend history for this fund, we'll see a very different story. In fact, 1 month, it paid out a distribution as high as 62 cents, but at its lowest, its distribution was 26 cents. So that's a major difference in the lowest and the largest distribution from this fund. But that fluctuation in distribution is simply not the case for SPYI. And you could argue this is due to a few different reasons. To start, SPYI writes S&P 500 index options instead of options on individual stocks, which can typically lead to a little more consistent options premium due to the fact index options are generally more liquid and less volatile than single stock options. We also have to remember this is an actively managed fund, so managers can make adjustments as needed, unlike funds that have a passive strategy. But then we also have to consider the tax efficient options. And this is so important to understand if you're interested in this fund. And it's actually part of the reason the fund is able to sustain such consistent distributions. To better understand SPYI, let's look at an example of JEPI and the tax implications of this fund, because it'll help us better understand how SPYI is more tax efficient. We need to understand that JEPI is forced to generate income by selling equity-linked notes. Now the problem with this is equity-linked notes are typically taxed as ordinary income. So assuming your adjusted gross income is between $85K and $150K per year, then your effective tax rate is around 17%. So if you assume you're generating roughly $50,000 per year in income from JEPI, you'd owe about $8,500 of that to the IRS. Let's compare that to SPYI. Unlike JEPI, SPYI writes covered call index options, which are classified as Section 1256 contracts. And this is something that NEOS points out in their fact sheet. But the fact they use Section 1256 contracts allows the income generated for their investors to be taxed much more efficiently. Along with this, the monthly distribution paid to SPYI investors for the most part is typically classified by the IRS as a return of capital. So let's look at that same example. Assuming you're a top 25% taxpayer with adjusted gross income between $85K and $150K per year, and you generate $50K of income per year with SPYI, you could expect to pay roughly $340 in ordinary income tax and $450 in long-term capital gains taxes. So this would save you a potential $7,710 in comparison to JEPI. So there are massive tax implications with both of these funds that you have to understand. So while the NEOS S&P 500 High Income ETF has only existed for around 3 years so far, what we can see as of right now, the fund has done exactly what it's designed to do. It's consistently provided large dividend payments on a monthly basis. It's been able to take part of the market upside, and it's been able to give out its distributions in a more tax-friendly way. A few things to keep in mind is the expense ratio is currently sitting at 0.68, which is probably somewhat average for covered call ETFs, especially since this one is actively managed. Along with this, we haven't seen how many covered call ETFs have performed yet in a true bear market. And so while I don't own any covered call ETFs in my personal portfolio right now, for people who are looking for immediate dividend income, it's easy to see why SPYI would be one of their top choices. If you have any interest in SPYI, then I'd suggest you do a little bit more research by jumping over to their website, looking at the fund's fact sheet, and looking at the prospectus. Again, one of the most important parts of all ETFs is reading the prospectus. I'll leave a link to all 3 of these in the comments and description down below. So go ahead and let me know what you think of SPYI in the comments down below, and like always, please don't forget to like and subscribe to the channel.